and welcome to this episode of Tide 10. My name is Michelle Gandhi, and I'm a principal on the investor relations team at Adams Street. Adams Street is a global private markets firm focused on private equity and private credit. Our clients have entrusted us to manage $42 billion on their behalf across primary and secondary investments, co-investments, direct growth equity, and private credit. Today, I have the pleasure of interviewing Tim Recker, Chief Investment Officer and Treasurer at the James Irvine Foundation. Tim and his team are responsible for managing the foundation's $2.5 billion endowment, which is used for grant making to fulfill the foundation's vision of a California where all low-income workers have the power to advance economically. Prior to James Irvine, Tim served for 10 years as a managing director of private equity and real assets for the Regents of the University of California. He's also had previous roles at the Michigan Retirement System and GE Asset Management. In addition, Tim is the former chairperson of ILPA. He is a trustee and chairperson of the IC for the College Preparatory School in Piedmont, California. And he's also a former trustee and current IC member for the Piedmont Community Church. In addition, he's also a frequent guest lecturer at UC Berkeley. Hi, Tim. Thanks for joining me today.
Thanks for having me.
Great. So let's get started. In 2008 and 9, the foundation community was among the hardest hit by the global financial crisis, and there were many lessons learned. Following the pandemic of 2020, can you talk about some of the lessons learned and implications on how you think about portfolio construction?
Sure. I think the speed of which the markets responded in 2020 were extraordinary. And I think you're seeing an acceleration of that over time in the marketplace. And so I don't think this is a one-time event. And so our ability to rebalance quickly is more difficult depending on whether or not you have liquid assets. And so for an endowment or a foundation that really has a lot of illiquid assets, we have several primary liquidity sources. We have some daily liquidity, generally our fixed income portfolio. And then we have monthly and quarterly liquidity out of our hedge fund portfolio. And the truth is, submitting a redemption for a hedge fund in March with quarterly liquidity was effectively useless. And so it really meant that we were underweight our daily liquidity relative to our quarterly liquidity in order to rebalance. Now, we were fortunate we did some rebalancing, but probably could have been a little more aggressive if we had more daily liquidity. And so that's something we've been talking about in terms of how to optimize on a forward-looking basis. If we believe that financial market corrections will be more compressed in their timelines, how do you think about the liquidity you need in your portfolio to manage that effectively?
Great. Yeah, no, that's definitely a good perspective. So now, where do you see the most attractive investment opportunities today? And on the flip side, what asset classes or investments trouble you the most right now and why?
Yeah, I'll start with the second part of that, which is we're very concerned around just the Fed's involvement in the markets, the scale of their involvement, and also fiscal policy. All those combined to really distort risk and risk-taking in investment markets and really reward riskier behavior, quite frankly, which I think can have significant consequences, as we would say, skew your behavior. And so it makes it difficult to think about how, as a rational investor who takes a long-term perspective, where you should invest, how you should invest, and how you manage the momentum aspect of the Fed's involvement. We have several managers that we would describe as outstanding managers, but their strategies have been neutralized by the Fed's involvement in the markets and not allowing us to profit from dislocation, even though we should be allowed to for investors that took too much risk pre-crisis. And so those are things we're reconsidering, trying to figure out how to balance that. In terms of what we find most attractive, I would say I deeply believe that we are in the middle of a technological revolution. Again, something that the last time was the Industrial Revolution, so more than 100 years ago. And I don't think everybody fully appreciates the magnitude of that impact. And so our portfolio is very much geared towards a forward-leaning new economy, not what I would describe as the old economy. And technology has been the leader of that. But as you think about technology and how it will sort of roll through all industries, all styles, it is no longer relegated to a particular vertical or sector. It really is all parts of the economy, and they're just different verticals. And so I think you'll see a shift over time. You're seeing it now in financial markets in terms of valuations of younger companies that are applying new approaches, et cetera. And so there's a lot going on. And I think we're excited by some of the potential profitability of some of these business models at scale that are much more capital efficient than prior business models.
Yeah, we would agree with that perspective as well. We tend to, as a firm, be definitely overweight, tech, given all the reasons that you just mentioned. Well, it's obvious that it's very difficult to meet with managers during this time period. How are you dealing with the virtual due diligence, and will you commit to new managers, especially emerging managers, without a face-to-face meeting?
Right. So we're fortunate to be in a position of strength where we have a very mature portfolio. We run a very concentrated portfolio where we describe as conviction-based investing, meaning that every single manager in the portfolio matters to our overall endowment performance and shows up. Then I have to explain performance if anybody underperforms because everyone matters. And so 25 managers make up about 85% of our assets, and we're hoping for multi-decade relationships. And so when we think about adding new managers, it's sort of plus minus one new manager a year. And an environment like this obviously has presented new opportunities, and we've taken advantage of that. We're in the midst right now looking at a new venture manager of Fund One. We've told them we don't need to meet them in person. We are happy to do that over Zoom. We believe we are able to reference them through our existing venture network, which is very strong, et cetera. I think we've positioned it as, if you want to meet, it's more about relationship building than about a decision process for us. And, obviously venture is a very long-term relationship. So the idea of not meeting someone and having maybe a multi-decade relationship may be unnerving. And so I think that, they've expressed more of an interest in me than we have, which has been interesting.
Yeah, I think the referencing and leveraging the network is definitely crucial during this time period as you get comfortable with, managers you haven't met with. Switching gears and perhaps as a final question, diversity and inclusion is top of mind for many allocators and managers. At Adam Street, we seek to increase diversity within the financial industry by increasing access, contributing to educational initiatives, and engaging staff in outreach opportunities. Now, I know the James Irvine Foundation is committed to diversity, equity, and inclusion. Can you discuss some of the foundation's initiatives? And also, how are you promoting diversity, equity, and inclusion with asset managers, and how can institutional investors do more?
Well, we're fortunate to start from a position of strength in this regard. We've been involved in DEI for many, many years. And I think we chose to take that a step further this year after George Floyd's death. We decided to become an anti-racist organization, which I think is a meaningfully higher commitment than just engaging in DEI. And we're fortunate that we start with a diverse board. So our board is very diverse. Our organization is extremely diverse across all spectrums, and our investment team is diverse, which is not true for everybody in the industry. And so we have an investment committee on Monday. It is one of the topics for the conversation in which I plan on presenting our framework for racial equity and how we want to operationalize racial equity in our portfolio and how we think about that and how we engage our managers on this topic. And I think it's an important topic. It's something that my team cares about. And we think that there's obviously systemic problems in the industry if you just look at representation numbers, and they need to change. And it's really a function of how do you go about doing that.
Yeah, no, that is fantastic. Well, Tim, it was a pleasure speaking with you today. I want to thank you for your time and your insights, and hopefully we can connect, in the future. If it's not 2021, then definitely 2022.
We are very much looking forward to meeting managers in person.
Great. Thanks, Tim. Have a good one.